I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event.
I think we've got another 5 to 10 years in gold. So yeah, in the commodities bull market.
If we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now.
Gold is still locked in consolidation, capped below $3,400 an ounce, but that doesn't mean the rally has lost steam. If anything, the foundation of this bull market is stronger than it looks. Analysts argue that what we're seeing now isn't the top, it's the setup for the most critical stretch still to come. MarioInnecco frames it within the bigger commodities supercycle. He sees gold extending its run for another 5 to 10 years. The reasoning is straightforward. Debts continue to climb, money printing never truly ends, and fiat currencies everywhere are structurally weak. That weakness, not temporary market momentum, is the real driver. He echoes the late Jim Sinclair's view that this won't play out like the 1980s or 2011 peaks, where a dramatic spike was followed by years of stagnation. Instead, gold is likely to remain elevated because the currencies measured against it are steadily deteriorating. CliveThompson takes the argument further. For him, gold's bull market ends only when the monetary system itself resets. That could take the form of a restructured dollar, a gold-backed framework, or even central bank digital currencies that impose new limits on traditional money. Until then, as governments continue to accumulate debt, inflation persists, and geopolitical shocks remain, gold and silver are likely to stay on an upward trend. Rafi Farber brings ratios into the picture. Since 2000, gold has consistently outperformed most commodities, though in fits and starts. Each pullback, especially the sharp one into 2022, has laid the groundwork for another leg higher. He sees parallels with the 1970s, when energy, metals, and agriculture rotated in leadership, but gold held its ground throughout. By that logic, today's consolidation looks less like a ceiling and more like a springboard for the next surge. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think we've got another 5 to 10 years in gold. So yeah, in the commodities bull market. Why do I say that? Well, I listened to Bert Doman. He's a fund manager, and I think he started out in the 70s. He's originally from Germany, but he's US based. And he said that in the 70s, he got his clients into gold in the mid-late 70s, and they did very well. And then in 1980, he told them, you need to get out of gold. We're going to have a 20-year bear market. And everyone thought he was crazy, but he was right. And then he said, but after that, there will be a 32-year bull market. And I think he looked at the price of gold going back a few hundred years in the UK, because the UK and the US are linked, the prices. If you add 32 to 2000, you get 2032, and that's why I'm looking for another 5 years at least. But I think Jim Sinclair used to say that the next move higher in gold, let's say, it's not going to be like in 1980, because we went up to like almost 900, and then the next 20 years we drifted between 250 and 400. He thinks it's going to stay up there next time. It's going to be different. So I'll let Clive answer that.
Well, I think the bull market, if you like, if we could call it bull market in precious metals, continues until such time as the currency has to be replaced by sound money. So how long does it continue? I think at best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. Whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event. But these things come along and they'll be pushed into a situation where people are running to the shops to get anything which will preserve its value. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Yeah, Rafi, how long more do you think we have in the gold bull market and commodities?
Okay, so we're in a gold bull market in commodities. So this is the gold to CRB ratio. All right, so it goes back all the way to 2000, but I picked 2010 here just so you could see.
Yeah.
This is if we're in a gold bull market, then this is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, and we've been in a bull market since 2000, but there've been major pullbacks. Right, this is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the oil, the lockdowns when oil went to negative 35, so that's why it went so high
Yeah.
here. But like we're about halfway up this spike when the lockdowns happened when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now,
Yeah.
relative
And
to
I
everything
think
else.
also the question, I guess, I think commodities, yeah, they're lagging gold, of course, but I think in terms of fiat, yeah, they moved up quite a bit from March 2020. They had that huge drop, like with oil, and then they went up, and they've been consolidating. But I also expect commodities to do well. But they also, I think, Rafi lagged gold and silver in the 70s. So even though there will be good places in commodities, and they take turns, don't they? They go up at different times.
For years, gold miners were treated like dead weight. Gold prices marched higher, yet the mining stocks barely budged or even lagged. Investors dismissed them as the dogs of the market. But something has shifted this year. Instead of selling off every time gold dips, miners have been holding their ground. In fact, they've started outperforming not only gold itself, but also the Dow, S&P 500, NASDAQ, and even Bitcoin. That's a significant point because the mining sector is relatively small compared to the giants of the stock market. Consider Microsoft, with a market cap of $4 trillion. By contrast, the entire global mining sector adds up to only a few hundred billion. That means it doesn't take a tidal wave of capital to send miners soaring. Just a modest flow of money is enough to spark outsized moves. The signs are already flashing. Major ETFs, such as GDX and GDXJ, are breaking out, with charts indicating clear bullish momentum. Historically, when miners start leading gold higher, it's been one of the strongest signals that a new leg in the bull market is underway. Rafi Farber, CliveThompson, and MarioInnecco argue that this combination, technical strength, sector size, and deep value, sets miners up as one of the most compelling plays in the next phase of the gold bull market. Let's get back to the interview.
Here's the price of gold in New Zealand dollars. So it's gone from, it was even lower than the dollar because the dollar, the low in the beginning of the century was $250. In Kiwi dollars, 178. And now it's almost 6,000. So I don't know where this guy's been for the last 25 years, if he's followed it. Rafi, any?
Well, yeah, so let's just flip what he said because he's right that gold is not really an investment. I agree with him on that. I think it's a divestment. The question is when you're trying to increase your wealth in stocks and bonds and whatever else it is that you want, what the stuff that you're not investing, are you going to have dollars or your currency or 30-year treasuries or whatever, or are you going to put your cash in gold? And I guess stable times, then you wouldn't want gold. You'd want cash because it would be more liquid and you'd earn, I don't know, a return, a small return on it, whereas in gold you wouldn't. But in times like these, when the inflation cannot be stopped, the inflation of the money supply cannot be stopped, and the devaluation of the currency, which is essentially a gold derivative anyway. If you own the currency, you own bonds that are going to be defaulted on one way or another. So, if he is an investment manager, I'm not disagreeing with Clive, but just to put it in different language, yeah, investment managers usually don't have any gold because gold is a divestment from the financial system. It's not an investment in it.
I agree. I mean, I think if you look at the 80s until the year 2000, it was like that. Gold was didn't go, it went sideways, and even if you'd bought it in the 70s, you'd still be okay holding it. But I think since the year 2000, things have become a lot more uncertain. So it has kind of acted like an investment because it's gone up a lot. But I guess a true investment would be investing in the mining stocks in gold and silver. So, yeah. Let's see if we've got more
Yeah,
questions
and
here.
th and those are
Yeah.
doing really well lately. I'm
Oh,
finally
yeah.
getting excited about them.
Let's have a look because I've got some charts here, Rafi. Let's look at the SILJ, which is the ETF for the silver miners. And yeah, so that's really, I mean, it's only goes back to 2013, but we're not, yeah, we're approaching the highs, and this looks like a head and shoulder, inverted head and shoulder, and we've broken the neckline. So I think we could go the same distance from here to here. Uh, so yeah, I think it looks. And have you guys noticed recently when gold and silver go down that the miners have held really steady in the past? When you saw gold and silver go down a little bit, the miners really dumped.
I mean, there's been a sea change in the behavior of gold mining stocks relative to the gold price. We've been through some decades, at least a decade, where the gold miners have been a big underperformer. Gold's been going up, stocks have been going up, and the gold miners have been the dogs of the world. But starting from around the start of this year, gold miners have been outperforming significantly the gold price and outperforming the Dow, the S&P 500, and funnily enough, Nasdaq too. So, in fact, they've also outperformed Bitcoin this year. So the money is drifting, and don't forget the sector is tiny, tiny. It's like 600, 700 billion dollars compared with, say, a Microsoft, which is $4 trillion. So only a tiny bit of money is drifting into that sector, but it's pushing the prices higher almost day by day this year.
It looks like the GDXJ that's breaking out, but it's lagging because if you look at GDX, it's near the 2011 high, and I think it's going to blow right through it. Yeah, there might be a little bit of corrections around the highs. Rafi, what do you think?
I think that when miners lead the metals, it means that that means that the bull market is just starting. And I think that's what's going on now. And miners have been hated for so long that still there's almost nobody in the sector. If you ask anyone who has a stock portfolio or even talks about, do you have any gold or silver miners? Are like, what are you crazy? No. But I mean, I really want to see what's going to happen to the gold and silver miners and the streamers and all those other stocks. What's going to happen when the Magnificent Seven, the Fangs and Nvidia and all that, when they really start to fall, and people really start to panic, then what's going to happen to the gold miners? I think they're going to go down, but I think they're going to go down very, relatively minorly
Yeah.
down. They might even go up. I don't know. I mean, if money panics out of the tech stocks and into gold, if gold is heading higher on some kind of realignment, then you could see gold mining stocks and silver mining stocks go up, even if tech crashes. I don't think it's going to happen, but I think it's possible.
You
Yeah.
know, by and
Sorry, go
large,
ahead, Clive.
by and large, the gold mining and the silver mining stocks are relatively cheap. If you look at the price earnings ratio for the current year, 2025, you'll see that many of them are trading at price earnings ratio of close to 10, some below, some a little bit higher. A huge difference between the price earnings ratio of these gold mining stocks. So a low price earnings ratio means relatively cheap. And the very high price earnings ratios we're seeing in the FANGs and the Mag 7, where the ratios are typically well over 30 times earnings. So 30 times earnings means if you buy a stock, you might have to wait 30 years before it earns what you paid for it. 10 times earnings means RP of 10 means you might have to wait 10 years before it earns what you paid for it. But of course, the advantage of the gold shares is the one thing which they're selling, which is gold, has risen in price since they calculated those price earnings ratios. So if you see a price earnings ratio of 10 on a gold mining stock now, it means that probably next year the price earnings ratio is going to be 7 or 5 because the profit they're going to make will be much higher due to the fact that the price of gold has risen since they calculated or last calculated that price earnings ratio. The value of gold mining stocks is incredibly cheap compared with every other sector of the market. And yet nobody's woken up and realized it yet. But I can see because the index of gold mining stocks is rising faster than everything else, some people have woken up, but it's still very small money and it's still very early stages.
So I've drawn up here the GDX versus the Nasdaq 100. So in the from beginning of this year till like I think it was April 21st, it outperformed the Nasdaq 100 massively, and that was when you had the that big drop in the stock market after that Trump Liberation Day in the beginning of April, and then the market has rebounded. The Nasdaq, so as normal, it rebounded quicker, or than the miners GDX. But now looks like it's breaking out again. So yeah, Rafi, it's difficult to say what they will do, but in relative terms, I think they will. Even if they might just not drop at all. If if the Nasdaq drops 10% and the miners go down 1%, that's a big victory, I think. So that's how I see it.
Momentum in the precious metals space is quietly building in a way that feels different from past cycles. This isn't just about bullion prices inching higher. It's about the shift in market dynamics that places miners at the center of the story. Once dismissed as a lagging sector, mining equities are finally attracting attention as investors recognize the leverage they offer in a sustained commodities uptrend. With their relatively small market capitalization compared to tech behemoths, it doesn't take a flood of capital to spark explosive moves. Layer that on top of structural weaknesses in fiat systems, persistent global debt burdens, and the growing push toward monetary alternatives, and the setup points toward an extended period where miners could dramatically outshine broader equities. If history is any guide, this could mark the early innings of a transformation where mining stocks evolve from market afterthoughts into the standout performers of the decade. As capital starts to rotate, the pressing question is whether institutional money will finally embrace miners as a core allocation, or if retail investors, once again, will be the first to spot the value hiding in plain sight. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.